In this video, we're going to work through the worksheet. Chapter 14 in-class bond premium is what it's called. Chapter 14 bond premium worksheet is the file name. And remember, we're selling this bond at a premium, so we get more money than the par value. Why did that happen? Because interest rates went down after we issued the bond, or after we talked about issuing the bond. Since we get extra money up front from the buyer, that extra money we receive, we can apply to reduce our interest expense over the life of the bond. So if you give me $1,000 extra, $20 extra dollars when you buy the bond, that's $20 in my pocket that I can apply to and give you interest later. So it's reducing the interest expense. So let's go here. BOCO Incorporated issues bonds with the following provisions. It's a $1,000 bond, 104% of par value. It's a premium. You're getting 4% extra. Stated interest rate is 10%. Rates went down after we issued the bond, so the price went up to 104. It's going to pay interest twice a year, and it's a 2-year bond. So let's work through this. What do we know? We know our par value is $1,000. We know we're going to get cash proceeds of 104% of that, which is $1,040, which means we sold it for a $40 premium. So how are we going to record the bond? Let's record that bond issue. Tell you what, let's go down here first and do it. You can see I got a bond payable for $1,000. That's my par value. My cash proceeds are $1040, so I'm going to debit cash for $1040. And the difference is a premium of, almost put it in the right side, right? $40. How do I know it's on the right side? It's a credit, because I have to make my credits equal my debit. Now, also, this is going to reduce expense. What do credits do? Reduce expenses. So as we convert this to a credit and amortize it, it's going to throw a credit up here in interest expense. So here's our entry. We got cash of $1040. We got a bond payable of $1,000. And we have a premium of $40. And there's our journal entry to issue that bond right there. Okay? And it's right here as well. Credit payable, credit premium, debit cash. Now, what do we do? Remember that here's our carrying value right here. Carrying value of that bond is $1,040. When it's time to pay that bond off, I would love that carrying value to be $1,000, because that's how much I'm going to send you in the mail. What do we have to do? We have to amortize this premium, similarly to how we amortize the discount. Well, I got $40 worth of premium. Just like with discount, I'm going to amortize it every time I make an interest payment. I'm making 2 interest payments a year for 2 years, so I'm going to amortize it over 4 payments, $10 a payment. Okay? So it's set up and we know where we're headed. So let's imagine it's June 30th. June 30th, it's time to pay some interest to you. So how much am I going to send you? Well, the stated rate is 10%. What's 10% of $1,000? $100, right? Are you going to get $100 interest? No. You get paid twice a year. You get $100 a year. We're going to split it up, and you're going to get $50 each time. So the first thing I'm going to do here is I'm going to send you a check on June 30th for $50. What a guy I am, huh? Then what are we going to do? I'm going to amortize $10 of my premium. So it's a credit, so I need to debit that for $10. Now I'm amortizing it, I'm reducing it. Okay. So what do I have here? I have a debit of 10, a credit of 50. What do I need to make it balance? $40. Another way of doing it is this. I pay the cash for 10, debit cash, credit cash, debit interest expense of 50. Debit premium, credit interest expense for 10. What's my net? $40. So here's my June 30th. Here's my June interest. Okay? It's now December 31st. What am I going to do? Send you a check for $50, I think. Amortize another $10 worth of premium. What's our interest expense? $40. So this is December. It's now June of next year. What am I going to do? I'm going to send you a check for $50 because I'm a nice guy. I'm going to amortize $10 more of premium. Interest is $40. And that's June. Now, we all need to agree that we would have closed out that prior year's expenses December 31st. This is just to illustrate. It's the only reason it continues on into the next year. Lastly, December 31st, I'm going to send you another check for $50 because I'm just that kind of guy. I'm going to amortize $10 more of premium. So we've got 50 minus 10 or $40 worth of interest expense for that 6-month period. So the bonds pay. 2 years have gone by, haven't it? Hasn't it? It's time to. Everything's done. What's our carrying value? Our carrying value is down to $1,000, which is good because I owe you $1,000. I'm going to send you $1,000 in cash and debit bond payable to wipe it out. Bonds off the books, premiums off the books. We recognize the interest. Everybody's happy. Well, let's put this in our amortization schedule then, huh? When that bond started off, we had a payable of $1,000 and we had an unamortized premium of $40. What was our carrying value? $1,040. The bond plus the premium. Remember that? Start out at $1,040. It's June 30th. What did we do? I sent you a check for $50. We amortized premium of 10, so I had interest expense of 40. My bond payable, by the way, is going to stay $1,000 for the life of this bond. That's what's printed on the bond. You can't change a whole lot. So June 30th, there's the payment I made. So what did I do? I amortized $10 worth of premium, which left me $30 to go, and my carrying value is down to $130 or $1030, I should say. It's December 31st. What am I going to do? Check for $50. Amortize $10 worth of premium. Expenses $40. Going to amortize here, and we've now amortized $20 worth of premium. We have $20 yet to go, and our carrying value is down to $1020. See where we're headed here? It's June 30th again. Another $50 check to you. Account and amortized another $10 worth of premium. Our expense is $40. We will now have amortized $30 worth of premium. We'll have 10 to go, and our carrying value is almost where we need it to be. Lastly, December 31st, another check for $50 you get. Amortized $10 worth of premium. Interest expense was $40. We've now amortized all $40 worth of premium. We have nothing left to go, and our carrying value is down to $1,000. Bond is gone. All we have to do is get it off the books. So let's amortize bond. Let's debit bond payable for $1,000 and credit cash for a like amount, $1,000. And that's how we deal with issuing, I should say, a bond at a premium.